Welcome to Ask an Advisor, where we here at Team Clark go deeper on all things investing and retirement. I'm Krista.
Hello.
Here with Mr. Wes Moss. And today, speaking of investing, you're going to talk about a couple of really interesting topics. What is a small cap and what's a large cap these days?
That sounds like that sounds rudimentary, small cap, large cap. The size of companies has changed so dramatically over the last decade that if you asked 10 people on the street, what's the size of a large cap? I don't know if people would know it because it's changed a lot. So it's a huge part of what we are forced to choose from in our 401k. So we have to understand this: what's small, what's large, what's mid cap, and they're really different.
And then also, why do individual investors often not beat the market?
Or why do they lag behind the market? And there's the most updated research we have on this is by a company called Dalbar, and they measure the performance of individual investors. They track mutual fund returns, and they're able to look at a really broad section of individual investors in America, and they can see how their equity returns, their stock returns do relative to the very indices that people are trying to match. And the returns for individuals are, I would say, dramatically lower, somewhat lower in some of the categories, and way lower in some categories as well. So it has to do with investor behavior in mass. Also super important to understand.
Okay, and we'll also get to your questions for Wes. You could submit those at clark.com/ask.
So this is a little numbers heavy. I'm going to have to put on my glasses here, but I'll see if I can remember all of these returns. And here we are. Let's just call this, I did this just the other day, and I checked today. So depending on when you're listening to this, the numbers obviously could change a little bit day to day, but just so far in 2023, there's been a big difference between
2023.
Did I say 2023? Yeah. I'm only 3 years behind, Krista. 2026.
It's okay. We're coming off a long weekend.
Just so far in 2026, there's a huge difference between the returns of the S&P 500, large companies, relative to the small cap indices and the mid cap indices. And as we sit here today, large stocks, S&P 500, up about 1.5%. Small caps up 6%. That's a pretty big difference. It's still really early in the year, but these two categories are dramatically different. And we'll go through the sizes of what's a small, mid, and large cap company. But the returns have been really different, even if we look over the last 3 years. I think that's why, in my mind, we're talking 3 years back to 2023. So if you go back and look at the last 3 year cumulative return, let's look at large versus small cap companies. The S&P 500 index up a little over 80%. If we were to look at the S&P 600 small cap index, it's only up 25%. Huge difference between those two, the huge difference in returns over a significant and an importantly long period of time. The Russell 2000 index, also a small cap index, up 40%. So you could look at this as that stocks in the largest of large, S&P 500, have essentially doubled the returns of small caps. So I think that's just right out of the gate an important thing to understand. However, and I'm not saying this is a durable trend just yet, but it is notable that so far this year, their small caps have been closing the gap to some extent. Where do we stand today? I remember, if I go back 10 years or 15 years, a company that was $20 billion was a really big company. $50 billion was a really big company. We have now entered a world where we have trillion-dollar companies today. Now, we don't have a ton of trillion-dollar companies, but a trillion-dollar company, remember, is 10 times the size of a $100 billion company. $100 billion company is still massive.
It's insane.
But a $1 trillion company is 10x that. Hard to even, for the human mind to conceive that. So the sizes have really shifted, and they have migrated up, as you can imagine, over the years now that we have trillion-dollar companies. So here's the new, let's call it standard. Well, again, let's just go back 10 years. 10 years ago, the median, and I'm looking at the middle stock. Remember, median is not the average, just the midpoint. 10 years ago, the median S&P 500 stock was 18 billion. Today, it's about 35 billion. So it has doubled in size. The average 10 years ago was 50 billion. Today, the average S&P 500 company is 100 billion.
Wow.
$100 billion market cap value. And these are the choices that you have. Most of us, if you're listening and watching, you have these choices in your 401k or your 403b or your retirement plan at work. You'll get a long list and it'll say large cap this, large cap value, large cap growth, mid cap this, then mid cap value, mid cap growth, small cap. So you have all of these choices, and the inclination most investors have is you go down the list and you see a 1 year and you see a 2 and a 3 and a 5 and a 7 and a 10 year, and you look at the rates of returns. So you're going to look at this and you're going to look and see all the large categories, the biggest of stocks, they're going to have really great returns, and people are very inclined to say, well, they've done well. That's what I'm going to invest in. Why would I put money in these areas this is up 80, this is up 40. I'm picking the one that's up 80. Mm-hmm. That is how 95% of 401k investing works. And that, to some extent, can be a problem because you start ignoring some of these categories that may have a higher probability of playing catch up and closing the gap. And that's what this story is really about today here. I don't want people to ignore a really important part of the market, middle-sized companies and small cap, just because large is done really well. So small caps today, in the world we live in, would be in the 500 to 5 billion category in total market cap. Remember, market cap is just number of shares times the stock price. Mid cap is 5 to 25 billion. Large cap is 25 now to 300 billion. And then even though you don't see this officially, even though you'll see some ETFs that say mega cap something, I would have to put the top part of the large category I consider mega cap. And those are 300 billion to over a trillion.
Wow.
to 4 trillion. Here's an example. I looked at the entire S&P 500 and I picked the middle stock number 250, 251. And it's a well-known name, and that's why I picked this one, but it also happens to be dead kind of right in the middle, at least the day I was looking. And that's Keurig, Dr. Pepper. What are they on? Everybody knows that company. It's a massive company. It's a $37 billion company. It owns, of course, Dr. Pepper. We all see the football ads of the Dr. Pepper, the little town they created. Canada Dry, Mott's, Snapple, A&W, 7-Up, Sunkist, Soda Squirt, Hawaiian Punch.
And Keurig,
that's just the coffee side, which is the single cup Keurigs that made single cup coffees famous. Yoo-hoo. Remember Yoo-hoo, the drink?
Yeah.
That's still out there. Big Red. I think that's just, I don't know. And Vita Coco, the coconut water. So this is a big company. It's $37 billion. And then you look at a company like Microsoft, which is not the biggest company on the planet, but number, I think, 3 or 4. It's a $3.5 trillion company. So that means Microsoft is roughly 100 times the size of a massive consumer brand like Keurig Dr. Pepper. Very different profiles size-wise. The smallest, just for fun, I looked, almost number 500 on the S&P 500 list was at the day, and this will change, Campbell Soup. Now it's just the Campbell's Company.
Okay.
And that'll fluctuate. But obviously, the time I checked, it was a little under 10 billion as the smallest company or one of the smallest in the S&P 500. So as far as why has the S&P 500 gotten so giant? It's because it's market cap weighted, but the other indices are too, and there's a disproportional amount of size on the top 10. And those top 10 companies have pulled up the average pretty dramatically, but they also, I know this was a theme last year, it's still a theme this year in 2026, if you were to look at the 10 companies at the top of the S&P 500, they are 40% of the entire S&P 500, which is a remarkable thing to think of. Just 10 out of 500, 40% of the entire index because they're so giant. Right now, average market cap, 100 billion. Median is 33 for the S&P 500. Now, the Russell 2000, which I think is a good proxy, this is an index, and you can find ETFs that do this, but if you're looking at just the index, the average company is 4.8 billion. In relative terms, tiny.
Yeah.
The median market cap is only 1 billion. Remember, we just talked about Campbell's, 10 billion. So the median company that's considered a small cap is still 10 times smaller, 1/10
than the
of the smallest company in the S&P 500. Who's in the Russell? You would think, well, these are tiny companies. Nobody knows these. Carvana, Rocket Labs, Bloom Energy, Abercrombie, Guardian Health. So it's still big companies that we know, but they're considered small when it comes to investing. Why could small caps be playing some catch up? One, they've lagged way behind. And historically, small caps, if you look over a really long period of time, small companies have actually done better than large over the course of, let's call it 50 years plus. So they've lagged behind more recently, and that may be why you're starting to see some playing catch up, and maybe that continues, maybe not over the course of the year. I just wouldn't ignore small caps, and they also are cheaper from a valuation perspective. They're not trading as richly relative to their earnings as most of the big, large cap companies. So the bottom line is to not ignore this category that has perennially actually done very well, even better than large caps over time, just because they've lagged behind over the last couple of years. I just wouldn't ignore them completely when you're looking at your 401k options.
Okay. We'll go to some questions. This is from Brian in North Carolina. This year, we have enough money to max out our Roths or max out our HSA, but not both. Both are invested in low-cost index funds. Which one should we prioritize over the other if we just can't max both options fully?
HSA versus Roth. Brian, don't make me choose.
I know.
They're both such good options because essentially they are paying for things on a tax-free basis. So they both have this wonderful. The HSA is like a 401k for your healthcare, but when you're paying for it, you're not paying taxes on the money that's going out to pay for XYZ healthcare bills. So the advantage of the HSA, the contributions are tax deductible. So it's like a 401k contribution. If you put $1,000 in an HSA or you max it out, it's 80. I think this year 8750 for a family. That goes off the top, and you don't pay taxes on it. So you get a big tax break for HSAs. Again, the withdrawals are tax free, and the growth is tax free. So that's an awesome combination. But the Roth is perhaps just as good because it's even more flexible. It's not that you can spend Roth money just on healthcare. So the HSA is limited to just spending on healthcare. The Roth, you can spend anything when it comes to when you get into retirement. So that tax-free growth is great. The tax-free usage is great. Big difference though, you don't get a deduction to put money in the Roth. So that's the big difference. So the HSA is probably the best tax deal today. And the higher the bracket you're in, Brian, the better the HSA is in the given year. And then the Roth, I'd say, is perhaps the most flexible. So if I had to just pick one, they're both great, but if I had to just pick one, I would probably go with the Roth because even though healthcare is extraordinarily important, your retirement long-term is, and I think tie goes to the Roth, but they're both very, very good. If you're in a really high tax bracket, so this would be the nuance, and you think you'll be in a lower tax bracket in the future, or if you're in a fairly high tax bracket, I would say that it swings back towards the HSA just a little bit. So you could just continue to split the difference. It's not a bad way to do it.
All right. Kevin in Ohio says, Wes, I wanted your take on dividend-producing ETF as a strategy of retirement. I don't hear many talk about it, but it seems like it could be a viable option. For example, I'll have a state-sponsored pension when I retire in 15 years, so that'll be my main source of income. I also have a 457B account that I'm anticipating will have approximately $250,000 in it when I retire. If I rolled that over into an IRA and into a dividend-paying ETF, paying an annual dividend yield of about 4%, that would give me an annual income of approximately $10,000 to go along with my pension. I'll also have a Roth IRA in retirement and no Social Security. Do you think this is a good plan?
Kevin, maybe I haven't pounded the table enough, or maybe you're new to the show, but this is dividend investing, income-oriented investing that's my preferred philosophy. It's not right or wrong. It's just
that's your jam.
That's what you would call it. As Krista would say, that is my jam.
Charts and dividend
payers. Because dividends. So first of all, over the course of economic or stock market history, dividends have made up over a third of the total return of the S&P 500. They get short shrift today because the big companies at the top don't pay a lot of dividends. So the dividend on the S&P 500 is de minimis. It's 1.2%. So it doesn't feel like it's all that exciting. And it's because the value, however, at the same time, Kevin, the overall aggregate amount of dividends is the highest it's ever been. It's just that the value of the market has gone up so much, the percentage yield is now lower. So I'm a big believer is when you get into retirement, particularly, so you've got your accumulation phase and your distribution phase. Retirement is when you're pulling money out. I like dividend investing for both phases because in the first phase, you can just reinvest the dividend, reinvest. In retirement, you're going to start using that cash. And to me, because dividends have grown at twice the rate on average of inflation. So if inflation's 3, dividends have grown 6. Growth of 6. That really protects our purchasing power. It protects our ability to spend on higher cost goods because our dividends are higher over time. And to me, it's a wonderful way to structure your overall retirement portfolio to make sure you have cash flow that you can regularly spend. The one catch I would just say, dividends are relative to the general market. And what I mean by that, if the S&P is only paying 1.2, a stock paying 3 is a really high dividend. It's more than double the S&P 500. So just note that as of today, dividend rates are relatively low. You can have a portfolio that has a 4% dividend yield, but you would have to really get specific on pretty darn high, not the highest, but high dividend yielders in that 3.5% to 4.5% range. There's not that many of them. So the way I would look at this, Kevin, is that dividends can do half to 2/3 of the work when it comes to that 4% withdrawal rate you're looking for. So if 4% is your withdrawal rate, your $10,000 on the $250. If dividends are giving you 2.5 or 3, it's getting you 2/3 of the way there. Then the appreciation, which is our equation we're all after, total return equals growth or income, dividends plus growth, should get you more than the rest of the way there.
Okay, and then Chip in Texas says, I love how Wes faces his challengers. To me, red apples are good and the rest are all for pies. That's funny. I forgot to mention apples are also your jam. You love apples.
But not apple jam.
No, okay. On a few podcasts,
there's apple butter.
I love apple butter.
I don't know. I'm not a big fan of apple butter. It's brown. It's mushy. It's
delicious.
I'd rather like a strawberry jam.
Take some toast, put some peanut butter on it, and apple butter.
Yeah, it's okay.
On a few podcasts, Wes has mentioned he loves a chart. That's speaking of charts.
That's also my jam.
I found the Callan periodic table of investment returns, which has an interesting presentation with the highest performing index that they review ranked for each year. It is rare to see the same index at the top. Is this chart useful to show that we should be diversified, or is it FOMO because it looks at yearly returns and not the longer time horizon for long-term investing? I think if these were 5 or 10-year returns, the chart would have a more uniform order. Is it useful to have 5% of your portfolio in something that kills it every 5 years but lags the more repeatable performers in the remaining years?
Chip, it's a FOMO chart, man.
FOMO, fear of missing out, just in case you don't
Chip,
know.
it's a FOMO chart, but it's also a good educational chart. What Chip is, I want you to visualize this for a second. Think of the periodical table in high school or college, and everything has its own little box, but think of it just as a rectangle. And there's a year at the top of each column. And there's a new color for the different asset classes that they're tracking. It might be precious metals, emerging markets, small cap value, small cap growth, large cap value, et cetera. And let's just say one of those categories is red. You look at this chart and red will go from one of the worst performers out of the group to one of the best performers in the group, and then one of the worst and one of the best. So you end up seeing visually that the category performance in any given year is going to bounce around. You might have a couple years where it's near the top, then a couple years near where that category is near the bottom. And I first think it's a FOMO chart because as a human, you can't help but look at the chart and say, oh yeah, large cap, precious metals, that was the best. It's at the top for last year, 2025. That would be let's say that's yellow. They'll usually put the gold one in yellow. And it's at the top and you think, oh, of course that was the best. And you go back through the year prior, of course large cap was the best. So you can't help but do a little Monday morning quarterbacking when looking at that FOMO chart you're talking about. So I think that that's the downside of that chart. It's a fear of missing out chart. You think, well, I'm just going to pick this category that does the best most of the years. Then money typically funds or funnels into what did the best last year, which often doesn't do the best next year or this year. So it's a FOMO chart, but it's a great educational chart, Chip. And I think you nailed this, and this is really why I brought up the small versus large cap, is that you want to have not necessarily all of those categories on that particular chart, but it's a reminder to own many or most of those categories because we don't know when the tide changes. And the blue box that represents small cap value goes from lowest return out of the group to the best. We don't know when that tide exactly turns. So the answer is to own them all or most.
All right, we're going to take a quick break and then we'll be back and we're going to talk about individual investors.
Welcome back to Ask an Advisor. I'm Wes Moss, along with Krista DeBiase here on the Clark Howard Show. Ask an Advisor. Mm-hmm. So where are you? Do you just want me to start with individual investor?
Yeah, let's talk about that and then we'll go to some more questions.
All right. I know we had a long first half of the show, so maybe today we'll be a little tighter on the second half. The emotional impact on investing. You could title this, Why Are Individual Investor, that's the average person who's making a trade at a Schwab account or Fidelity account or Vanguard account, why are their returns lower, so much lower than the index? QAIB, the quantitative investor analysis or quantitative analysis of investor behavior. It's a study that gets redone every year by a company called Dalbar. It's a research company, and they're measuring the actual performance of individual investors. And just to kind of put this in focus, just because a fund, let's say a mutual fund does 20% on the year, it doesn't mean that everyone that owns that fund got 20%. Mm-hmm. Because people could have started later in the year. They could have put more money in at any given time. They could have taken some money out. So to really get your actual rate of return, it's got to be from when you were invested and calculate if you put money in and took money out. Also fees, taxes, all these other things. So the headline number doesn't necessarily, in fact, it often does not mean that you had the same rate of return. And that's kind of the methodology they're going with here. They're looking at the actual return and taking all these things into account. And as you can imagine, because of buying and selling and switching and redemptions, timing decisions, funds that are doing well, or let's call it, whether it's an ETF or a stock for that matter, but they're measuring mutual funds. Funds that are doing well tend to attract money, but they attract money once they've already done well. So people are typically getting coaxed in or just incentivized because of past performance to be putting money in, usually at a time when now the fund is not going to do as well.
Sure, you're looking at a snapshot and you're like, well, that did
Looks
better.
good.
Yeah.
And that whole tide, it's like the tides of the sea. It just continues to happen in the world that we live in, and there's a real price to that. The actual rates of return. So think of it this way: if you got the S&P 500 over the past, I'm going back to 2005, up 700%. Inflation, or the power of our consumer dollar over that same period of time, is down about 50%. So it buys half of what it used to buy 20 some years ago. So we're almost forced to invest in a market in order to keep up with inflation, in a market that averages negative 16% intra-year decline in any given year. So no wonder it's pushing and pulling people out at any given time. It is an emotional environment to be in, and we are human, and we are inherently attracted to something that would be good for us and run from something that would be bad. And that's why the tug and pull of emotions really matters when it comes to investing, and it impacts returns. So here's what Dalbar says. If you look over the past 10 years, the S&P 500 as a proxy for stocks over the last 10 years, and this was as the end of, this is their 2025 report. So it actually, the data cut off in year 2024. This is their 25 report. S&P 500, a little more than 13% on average. The average equity fund investor, 9.8%. So it's 30% less over a decade. That's a big number. The average balanced investor, that is 60% stock, 40% bonds, if you were to look at what those averages would have come out to, 8.4% per annum. The average asset allocation fund investor, 4.3%. Half. The numbers are even, well, you could look at these as even worse. Here's a 20-year period of time and looking at fixed income. The aggregate bond index over 20 years has averaged a little over 3%. So it's still not great. This is not great returns, but a positive on average 3%. The average fixed income fund investor, negative 0.25. It's a really big difference.
Wow.
And it's not to say people are bad investors. It's just that they get pulled in. And I think in this case, they get impatient. So it's like, oh, this fund hasn't done well. I'm going to get out of it. And then it eventually starts to do well again. So the gap is because of the emotional reactions of volatility, the poor market timing, buying high, selling when things are low, chasing performance, et cetera. And that is just a perennial issue. And I just think the more education we have around that, the less likely you are to fall victim to this. So make it a simple investment plan, or make investing simple, have a written plan, continue to be educated on this, diversification and balance, all those things can help you fight against the emotional returns, the emotional burden on your returns over time.
Okay. Well, some questions for you, Wes. Tammy in Florida says, my son received a settlement for $70,000. He's afraid that the stock market is a bubble. He's 34 and just began investing in his company's 401k and Roth IRA. What do you advise? He lives in California, has no debt, but his rent is $3,200 a month. He works full-time, and even though he makes around $100,000 per year, it's a real struggle in California. He's maxed out his 401k and Roth IRA and is looking for ways to reduce his tax burden. Please help me help him.
Sounds like a Jerry Maguire quote. Let me help you. Let me help you, Tammy. This is a time horizon question in disguise. Because everyone's always worried that the market's about to go down. The market's always in a bubble. We're always worried about that. And then when stocks are low, we're worried they're going to go even lower. So it never feels like a good time to invest. However, for some reason, your son has no problem putting money and maxing out the 401k. So why is that? It's because it's assigning him a long time horizon, almost subtly without him knowing it. And it makes it so that, I can invest in stocks. Of course. So why would you not, if he's going to put 25, maybe he has $50,000 invested in stocks in the 401k, why is that safe? And you don't want to invest any of the 70,000. It's because you subconsciously know that the 401k is long-term money, and the chances that it's going to be worth more in 5 years and 10 years are very, very high, even if we are going into a correction the day after you invest. So so I would to help you help your son, ask him to extend his time horizon out and think of this as retirement money. Now, it may be prudent that half of this money, maybe $35,000 of it, should be emergency fund money. Maybe half of it does need to stay in a money market because it gives him the cushion that we all need in particularly a high cost place like California. So maybe it's prudent to say half of it stays in money market, but then assign the other half of it a long horizon. And I think it can get invested for somebody 34. He needs to invest it. He just needs to know that he's not going to touch it for a very long time.
Okay. And then Anonymous in Tennessee says, "Hi, Wes. We've heard from Clark about when to opt for Roth versus traditional 401k. I don't think I've heard your thoughts. My wife and I make $400,000 a year, and according to Clark, we should opt for Roth. But I've read that a good rule of thumb is to mix both and have your age plus 20 as the percentage of traditional and the rest as Roth. Thank you for your thoughts."
Okay. I guess I like that Clark has the rule of thumb. He uses aggregate income. And I do have the 2026 tax bracket somewhere here. Let me go to that. So again, this is a question around Roth or regular. And so first of all, I don't know of a rule of thumb of age plus 20 for this. I don't I love these rules of thumbs. That's maybe we'll get to 5 different jams today. I think dividend investing, apples, the rules of thumb, they're on my jam list. I think of it as a tax bracket. So the reality is that I land right where Clark lands. He thinks of it as if you're married filing jointly 2026, the 24 bracket is $211K up to $403K. And that's why Clark's saying anything under, if you're making 400 or less, Roth. If you're making 400 or more, traditional 401k, because you get the tax deduction, and that's potentially more beneficial because of the big deduction. So I think of it as brackets. The brackets move slowly, from 10 to 2. Well, then there's a jump to 22, and then it's just a 2% jump to 24, but then it's an 8% jump to 32. So meaning that for every dollar over that 403,000, you're now taxed at 32%, not 24. That's a huge difference. So Roth versus regular 401k is just it's a taxes today versus taxes in the future. If your taxes are going to be the same or higher in the future, and a lot of people they're around the same, then the Roth makes all the sense in the world if you're in the 24 bracket or lower. Again, 403,000 is the top of that bucket. If you're going to be in a lower tax bracket in the future, then the 401k actually does make more sense. And if you're in the 32 bracket or 35 bracket or 37 bracket, then you're paying 37% to get it into a Roth, when in the future you're only going to be in the 25. So in that case, high income folks above the 24 bracket should be using the traditional 401k above that bracket. That's my rule of thumb, is that demarcation. There's only one little catch there, and that's if you're, let's say, 10 grand over. So you're at 410 or 415, it may make sense to use 10 or 15,000 of contributions to keep your income in the 24 bracket or lower, and then do the rest in the Roth.
Okay. And Greg in Utah says, "Hey Wes, I'm setting up a Roth IRA for my daughter who made about $1,000 in 2025, but she netted less after deductions for FICA, tax withholdings, etc. Can she contribute the full $1,000 or less, the net after FICA or any other withholding? Thank you for all you do. I've been a Clark listener for so long, I don't remember when I started."
Well,
thank you for listening.
Hopefully you remember when you submitted a question and we highlighted it here on the show and we answered it. And thank you, Greg. The answer is gross. It should just be, she earns $1,000 just because she pays taxes on $100 or $200 in taxes, whatever it might be, or FICA, maybe it's $150 or $70. It's the gross amount. And it's just about, again, to be able to qualify to do a Roth, it's earned income, wages, tips, consulting fees, professional fees, anything you're earning by doing something counts, and it's a gross number. What doesn't count for Roth is dividends, passive income that just comes in. If you have just dividends, that doesn't count towards earned income. And if that's your only income, then you wouldn't have enough to put into or make a contribution. So I think she's in great shape, and that's a smart move. It's somebody that young.
I love it. Okay, well, thank you so much. That does it for us today on Ask an Advisor. Clark will be back tomorrow.
Thank you. Great questions today.
Lots of fun. Send your questions to us, clark.com/ask, and have a wonderful rest of your day. Thank you.